Right, so everybody right now is talking about tariffs, right? About China and about the trade wars. But I think there's actually something bigger going on. And if you're only looking at the headlines, you actually might be missing that. So, yes, recent tensions have absolutely triggered a sell off. And yes, the tariffs might have affected short term numbers. But the real story, I believe, is the one that could be shaping up the next few years of global investing, which is about perception, confidence, and capital flows. That's what we should be looking at and talking about. So, in this video, I want to dig into why investors are globally pulling money out of the US ETFs, how China's bond strategy could shake up the dollar, and what happens when perception, not so much fundamentals, are driving the markets. But of course, nobody has a crystal ball, right? I'm just trying to see the signs and see how all of this might come together. And in the end, obviously, I'm going to share with you my personal view and what I'm doing with my own investments. But let's have a look at the data. In March 2025 alone, that was before all the tariff drama, European domiciled US equity ETFs, the likes of S&P 500, VUSA, SPY5, saw a net outflows of 1.3 billion together. The month before, another 519 million pulled out. That's a sharp reversal from January when we had $10.5 billion in net inflows. That was obviously right after the election of Trump. And then we saw his real policies in action. A lot of people got scared and pulled their funds out of it. Meanwhile, European equity ETFs actually pulled in close to $9 billion in March. Now, I haven't seen the April numbers yet, but I'm sure it's going to be even more of the same money being pulled out of the US and relocated, obviously, in Europe or other markets around the world, because people really have some serious question marks about the direction the US is going. So, what's going on? Well, it isn't just about tariffs anymore. It's about something else, which is sentiment. I think that's a huge driver in the markets. Both retail and institutional investors are definitely starting to rotate. Some are saying maybe it's time to look elsewhere. And others just want to reduce the concentration risks, right? And we have to remember, ETF flows aren't just numbers, they represent belief. And belief is a fragile thing. If you believe in something, you put your money towards it. If you stop believing it, well, guess what? You're not going to put your money there anymore and you look for other places. So it's a very powerful concept. But I also want to talk about China, right? Because now that they've been slapped with huge and major tariffs from Trump, now, of course, they feel really upset about that. And one huge lever that they have is all the US treasuries that they're holding. Up to around $800 billion of treasuries, basically US issued debt, is what they're holding, which is huge, right? Now, if they were to start dumping that and basically selling it back to the market, that would bring up the bond yield, basically the interest you would get as a bond holder. And you can see already for the last 5 days, since we had those shenanigans going on, it went up by 8%, right? So, definitely the market is reacting very strongly to this. And yeah, I think if they continue selling off more and more, that number might go even higher. And what that means is that the interest to borrow becomes ever more expensive for the US. So basically the US government has to pay back those loans at a higher interest, right? The same way how we take a mortgage from the bank, if the interest rate goes up, we pay back more to the bank in the form of interest. Same is here with those bond yields. The higher they go up, the more expensive it becomes to the US government. So they have quite a bit of leverage with those bond holdings that they have if they start selling them off now back to the markets. And more importantly, if confidence in the US dollar erodes along the way, we could see long-term investors, even pension funds, sovereign wealth funds, start relocating away from the US altogether. So you can see how it's all connected, right? It's not just isolated cases. They really come together, these forces, and obviously, again, work towards sentiment and confidence in the market. But hey, this is not about panic. I don't want to worry you, but it's more about strategy and knowing what's going on. And when strategy changes, money moves. So that's something we have to keep in mind as investors. Obviously, you don't want to be left holding the bag. And I wish it was different, but markets don't always respond to earnings. They respond to emotions. One of the best examples is obviously Tesla. Fundamentally, Tesla is still a solid business, right? They're innovating and they're still a strong brand. The problem, however, is public opinion around Elon Musk. His political statements, his tweets, polarizing persona, all of that has driven the stock more than delivery numbers ever could in the past, which was great for Tesla investors. However, now the narrative is changing and people are actually dumping the shares, selling the cars, getting rid of that, and it obviously works against the company. And that's exactly perception over fundamentals. And I think similar thing is playing out right now with US stocks in general. We're seeing a shift in the mood, not necessarily rooted in reality, because I still think we have amazing companies in the US to invest in, enough uncertainty, enough noise, and the crowd starts drifting. That always has happened in the past and will always happen. This is why we're seeing money flows out of even the most established ETFs. So it's not because the companies are failing, it's because belief is wobbling. And guess what? When belief wobbles, prices usually follow. But of course, that's where things get interesting again. Outflows of capital can also create openings and opportunities. When capital exits a market, prices usually fall, right? People sell off, the prices come down. Same what we've seen with Bitcoin in the past and other stocks. And when prices fall, assuming fundamentals are still intact and strong, well, that's when long-term investors start circling in again, right? So it's a constant in and out of markets. So while some people are pulling out of the S&P 500, ETFs and other indices, others are quietly loading up. And that's why I'm always talking about dollar cost averaging, right? Because here's the thing, short-term fear often creates long-term value and opportunities. So if this continues and valuations do get compressed and come down from previous all-time highs, well, you start hearing people say, hey, you should really look at US stocks because they're starting to look cheap again. And we're seeing this already. Look at Google, for example, now has a PE ratio of 17.7 forward PE. It's crazy how cheap it is, really, when you compare it to some of the other stocks. Of course, looking at Tesla, for example, I mean, you see quite different numbers, 98, even though it used to be even higher at some stage, 170, I believe. Still outrageously valued, in my opinion. But I do feel we're going to see a bigger correction coming in going forward. You can see that's how cycles work. Money flows out, prices drop, things get attractive, money flows in again, right? It's a constant up and down. But for the long term, we've seen this as an S&P 500 investor. Well, if you do hold on long enough, you can see here over a 10-year period, up nicely. Despite major corrections along the way, long term, you're investing in fundamentals. And well, they turned out to be just fine. So whenever there is a crisis, capital flows out, others see the opportunity, capitalize on it, and bring the markets back up again. So it's a constant ebb and flow. But yeah, for the long term, obviously, it worked out in the favor of long-term investors. So while you see the headlines screaming outflows, the savvy investors are already planning the next re-entry into the market. But I also want to talk about diversification. There's a really famous quote from Warren Buffett that I really like. And he said, diversification is the protection against ignorance. It makes very little sense for those who know what they're doing. Look, I'm not anti-diversification. I'm quite diversified across different asset classes myself. However, there is a difference between smart diversification and blind diversification. Just moving money out of the US because you're scared or because the media says so, I don't think it automatically makes it a good move. Because many of the companies we have in Europe or other developed markets, well, they aren't necessarily growth leaders, right? Really, realistically speaking, I wish they were, but reality is they're not innovating at the same scale and they don't have the same global reach that some of the US companies. So in reality, you're not suddenly getting a better business. You're just getting a different one. And that's fine if that's your strategy. But let's not confuse movement with progress. So I feel a lot of people, by diversifying into other continents, they feel better about themselves and safer. But again, fundamentally, it doesn't necessarily make it a better investment. But take the extreme example. If you took all the money that you have in the US and put it into Mongolian stock market, I don't even know if Mongolia has a stock market. And if any of you watches from Mongolia, there's no disrespect. I'm just saying maybe the growth opportunities and depth of great future-proof companies over there is probably different than the one in the US. Yeah, you're probably more diversified if you split it across Mongolia and some other, up-and-coming countries. But does that make it a better investment? Well, I wouldn't say so. So now that we looked at the flows, fundamentals, geopolitics, sentiment, and strategy, what am I doing about this going forward? Well, of course, I'm not oblivious to what's happening in the world. I really keep a close eye on it. But at the same time, I've been in the game for a number of years and I have seen those major market corrections and fluctuations for a while to not really scare me. When we recently had the Black Monday, right, the portfolio dropped massively. My portfolio across the board was very much in the red. I didn't panic at all because I'm really investing in the long term. And for me still, fundamentally, I haven't seen a major change to my investment strategy because I still believe those US companies are going to dominate in the coming years. When I look to AI, to technology, they're just the leaders. Yes, of course, China is extremely strong in manufacturing. They're up and coming with some other companies. But I'm right now not in a position to all of a sudden start investing my money in there because still I have a lot of questions mark about that. I totally get how a lot of people put money in Europe. And I would love to put more money into Europe as well, being a European myself. But I just don't see enough strong, innovative company and the depth of innovative companies. We have amazing companies like ASML and others that are really doing amazing things. Don't get me wrong. But if I was to invest into an ETF right now there, I just don't feel my money would work as hard for me as it would in the S&P 500. Prices have come down, and for me, that presents a really great buying opportunity. And ultimately, I just continue to dollar cost average. I mean, yes, it's tempting to invest even more right now, but at the same time, maybe we'll see even more correction, and I might be out of money, and I wish I had more money and buy yet another dip, right? As we say, the dip keeps dipping, so I'll just continue dollar cost averaging, don't look at the portfolio too much, don't look at the news too much, and just let it do its thing over the long term. We've seen those numbers. Historic returns are not a guarantee for future returns. But if you were to start doubting the S&P 500 performance in the coming years, I totally get it and respect it. But at the same time, I honestly don't think that we start seeing the European ETFs or Asian ETFs massively outperforming the S&P 500, at least not for the long term. Yes, there could be short-term fluctuations where there's a bit of shift of capital from one market to the other, but long-term capital flows to fundamentally strong companies, and that's what I'll continue doing going forward. Because honestly, the way I see it, temporary fears create long-term opportunities. But do let me know in the comments down below, are you investing more outside the US now? Are you doubling down on the US? Happy to hear from you. Next up, check out this video here. As always, thanks a lot for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.